You've worked hard, saved diligently, and now you're approaching retirement. But here's the question most people forget to ask. If I were to hire a financial advisor, how and what would I be paying them? Hello, everyone, and welcome back to the Planning for Retirement podcast. I am your host, Kevin Lau, and today's episode is going to be a spicy one. It's going to be very, very exciting for me to deliver. First and foremost, it's Independence Day week, so happy birthday, America. Happy 4th of July to all of you. Hope everyone enjoyed their holiday weekend and just spent time reflecting on how fortunate we are to live in the great US of A. Earlier this year in February, our firm, our financial planning firm, Imagine Financial Security, also celebrated 4 years of independence ourselves. So first of all, thank you so much to all of our valued clients who trust us with their life savings. We do not take that lightly. To help them maximize their retirement spending, minimize their lifetime tax bill, and worry less about the financial markets. But I'm also so thankful I can do this podcast and the YouTube channel. Working at a big firm, this would never be possible in a million years. So very excited about what we've accomplished and also what's ahead. So I spent over a decade at traditional financial firms, financial firms where things like talking about taxes, that was completely off limits, or financial planning played a backseat to investment management. And yet that's what many advisors are still doing today, charging 1%, 2% of your hard-earned assets just to quote unquote manage your investment portfolio and calling it a day. Well, today we're going to be talking about what you're going to be looking for, okay? And more importantly, what to avoid when hiring a financial advisor in retirement. If your advisor is just picking funds and rebalancing a portfolio, but not helping with things like Roth conversions or tax planning or navigating your withdrawal strategy, you deserve better. And these days in 2025, you can absolutely do better. So I'm going to qualify one step further and say that this episode is probably best for someone who is around the age of 60, give or take, and has accumulated at least $1 million for retirement, probably closer to the limit of about $5 million, or the upper threshold of $5 million. If this isn't you might still learn some things, especially if you're trending in that direction. But if this is you will probably get the most out of this episode because those are the type of people that we serve in our practice. So I'm probably most qualified to speak about fee structures and service deliverables for that segment of the market. Before we jump in, I was thinking about retirement planning after playing golf a couple of weeks ago. All right. So 2 weeks ago was our club championship, and they had the gross winners, the net winners in each flight. First, thank you to my wife for green lighting me to play 18 holes Saturday and 18 holes on a Sunday during summer when kids are out of camp. So thank you, honey. But I was super jazzed up because just practicing on the driving range the week ahead, working on my putting. I haven't been playing a lot of rounds, but I felt pretty good about my game, and the anticipation and the excitement was building leading up to Saturday, leading up to that opening tee shot. So go out to the first tee, first hole. I'm the first one to tee off. They put us off in threesomes. I block my first shot, my first drive, right, out of bounds. I had to reload, put down a second ball. So that's a penalty stroke for number 2. So I'm hitting my third shot off the first tee. I do the same thing. I block the drive again to the right, out of bounds. Took a triple bogey on the opening hole, which is the maximum, by the way. So triple bogey was the maximum. I steadied the ship. I was pretty proud of myself. I steadied the ship for, a nice stretch of holes. Felt overall I played pretty well, but I walked off that day with an 89, which for some of you listening, you're probably like, an 89, what are you complaining about? But I'm playing as an 8.5 handicap, so that did not help. Okay, I was definitely pretty far down on the leaderboard. But double bogeys are momentum killers. Triple bogeys are round killers. And I made 2 triple bogeys and 3 double bogeys that day. So on 5 holes, I was 12 over par. The other 13 holes, I was only 5 over par. And that included, by the way, 2 birdies in there. So it had me reflecting. And that's oftentimes what I do after playing golf, especially my bad rounds. I usually reflect more on my bad rounds. And it just hit me, golf is not a game of great shots. Of course, they feel amazing in the moment. And I hit some of those great shots that day. But good scoring, good golf is about eliminating or minimizing the damage from your bad shots, knowing where not to hit the ball, knowing where the trouble is on each hole, especially if it's a new course you haven't played before, when to take your medicine and punch out of the tree line as opposed to going for the miraculous slice around the trees, or how to keep your cool when things are not going well. So what does this have to do with retirement planning and this episode in general? So many things. We had a client hire us about a year ago. We did a one-time engagement for them about a year ago, and they had accumulated a decent chunk for retirement, about $4 million. And they had always been DIYers. They had always done it themselves. But after discussing their goals, their concerns, their financial situation, we crafted a game plan with specific recommendations, and the light bulbs finally went off for them. They had been converting to Roth accounts for years when that didn't make sense any longer based on their circumstances and their situation. They were taking on way too much risk in their portfolio relative to what they needed to at this stage in life, risk capacity. They finally had clarity on how much they could comfortably spend from their portfolio and specifically from which accounts. In other words, someone who had done very well on the surface DIYing had their blind spots. We all have them. In my business, Roberto, Amy, they keep me in check with my own blind spots. And I think that's why we make such a great team. So yes, I am very biased because I do this for a living. So I just want full disclosure out there. I do this podcast, but I also do financial planning for a living. And so yes, I'm biased, but I've worked with clients for nearly 17 years. And I truly believe having a great financial advisor can help you avoid those double bogeys, avoid those triple bogeys, help you play conservatively when you think you should play aggressively, or help you play aggressively when you feel you should play it conservatively. It relates on so many fronts. And I love the golf analogy. So, I'm going to bring them to the table every week. And even for many DIYers out there, okay, you might be thinking, I don't have blind spots, right? Well, listen, first of all, we all have them. We don't know what we don't know. But even for a lot of the DIYers out there, even if there's one or two seemingly small opportunities that could potentially add value, that could be multiples of the fee that you actually pay over your lifetime to a competent retirement-focused advisor. And many of you in PFR Nation, you're kind of like me in that sense. Some might call it skeptical, okay? My wife she calls me a skeptic all the time about things. It's weird. I'm optimistic, but I'm also skeptical. It's kind of an interesting combination. But I don't believe in the too good to be true traps. I don't fall for those. And you, PFR Nation, you're also savvy, in my opinion, and you don't fall for these traps either. And when trusting financial advisors, you also tend to lean away. And believe me, I get it. I worked at big box firms for the first 12 years of my career. And that was a big part of why I left to start my own firm. It was because of my healthy skepticism that I had in terms of what we were doing, but more importantly, what we were not doing that was in the best interest of our clients. Now, does that mean all financial advisors are bad if they work at big box firms? No. Okay. But part of why I wanted to do this episode was because I had that experience working in the different fee models, working in the different financial firms, and understanding like, hey, let me pull back the curtain for all of you in PFR Nation and sort of give you an understanding of what to look out for, especially when you're looking to hire a financial advisor as you approach retirement and then execute a successful retirement. The first thing I wanted to touch on was this concept of free financial planning. So when I first started at one of the big broker dealer / insurance companies, not going to name names, but this was back in 2008, we used to offer, quote unquote, free financial planning as part of our delivery, okay, our value proposition. And I thought, wow, this is so amazing. We're so nice. We're adding so much value. Remind you, I was 21, young and dumb at the time. But over time, I realized the entire financial planning tool was essentially designed, and the process was essentially designed to get people to buy life insurance, buy annuities, or some other financial product that they may not need or want. Okay. One of my favorite quotes is, if you aren't paying for the product, you are the product. Now, you might be thinking, hey, Kevin, I'm not paying for this podcast. So what's up with that? Well, you got me there. I will admit you are my product. Okay. So, of course, I want to grow. I want to help people. We do this for a living. We want to grow. We want to help people. We have the capacity to help more people. But I think more importantly, I strongly believe we are one of the great firms out there in terms of what we do and how we do things. Okay. But I digress. But if you're going through a process like that, which feels comprehensive on the surface. You're like, hey, they're asking me for a bunch of stuff, a bunch of statements. They're asking me a bunch of great questions, qualitative and quantitative questions that I may not have thought before. But you haven't paid a dime yet. Just keep your guard up. Okay. It's very likely they're selling you something. Oftentimes it's insurance or some sort of annuity or structured product, or they're going to be talking you into moving all of your assets to manage under their umbrella and charge you a percentage. I'm not saying these solutions are all bad. Many of them are great solutions and absolutely should be used in a comprehensive financial plan. But that model, it leads to conflicts of interest, okay, where an advisor will, of course, lead with a certain recommendation because that's how success is measured at their firms, or that's going to impact their paycheck differently than if they were to recommend a different solution, okay? So I just wanted to start with this concept of free financial planning. Be very skeptical of that, okay? And this is a big part of, in my opinion, why people get sucked into buying things they don't need or want. Because these firms, these big financial firms, are absolutely amazing at training advisors to sell clients. They're tapping into your emotions. They're tapping into your deepest fears. And then they're tying their solutions and their products to those fears and to your deepest concerns and what's important to you, what your values are. Not saying, again, that the end game product or solution is bad for you, but oftentimes it could be done in a different way that's more aligned with your best interests as opposed to what's best for that firm that's selling that product or that advisor that is selling that product. So why don't we jump in to the different fee models? Okay. Now, I will admit, this is a complicated deal. And I did write an article about how to find a retirement focused financial advisor. And I'm going to link that in the show notes and I'll reference that later on. But if it's helpful, you can reference that blog post and then can reconnect with this podcast episode to really try to make sense of this one. I'm going to try to keep things really simple, knowing that there is some complicated jargon and probably terms that may confuse you. But I'm going to try to keep this high level, but also valuable. So the first model I'll talk about is the broker dealer or the insurance sales model, essentially is what I'll call it. Now, where you see this is any big financial firm, okay, like your traditional big brokerage firms like Edward Jones or Raymond James or LPL, insurance companies like a Northwestern Mutual or a Mass Mutual, New York Life, Guardian, banks like JP Morgan, Wells Fargo, Merrill Lynch, Morgan Stanley, etc. Any big financial firm most likely has some sort of securities and insurance arrangement to sell investment and insurance products. Now, on the broker-dealer side, the way they get paid is very simple. It's from selling commission-based products, whether it be mutual funds or annuities or insurance, whatever it might be. They're selling some kind of structured product that has a built-in commission in there. And oftentimes you may not see that commission. You may not even know what that commission is from a dollar standpoint. But we're going to talk about that in just a second. And then they also may receive some trails from those products. So they're going to receive a large upfront commission in that first year in which you purchase them. Again, not saying that the product's bad, but I'm just telling you this is how they're compensated. And then they may receive some kind of trail or revenue sharing from those particular products for the duration that you have those in place. So if you cancel it in 5 years, then that trail goes away. So there is some incentive there to keep that particular business on the books. Now, sometimes these advisors also charge a percentage of the assets that they're managing. So not only are they selling commission-based products, but they're also charging a percentage for any investments that they're managing on your behalf. Okay. So, overall, as you can see, this is why there's so much, I'm going to say negativity, but there's a lot of skepticism in this model. Okay. Any big financial firm, there's a healthy dosage of skepticism. Okay. And rightfully so. The advisors are typically incentivized heavily to sell products that are being pushed by higher ups at that particular financial firm. That may not always be the best fit for you in your situation. Okay. Another issue is that the fiduciary standard doesn't really apply in these scenarios, okay? Now, it's very common that the advisor may serve as a fiduciary sometimes, but then sometimes they may not. And so, again, if you're dealing with a broker-dealer relationship with one of these big box firms, just know that it's possible that the advisor or they could put themselves out as a fiduciary sometimes, which may also lead to some confusion to you as well. The only true fiduciary model is the fee-only model. okay, from a definition perspective. Now, you can argue whether or not certain advisors that are fee only versus broker dealer advisors are acting in the best interest of the client. We'll talk about that in the podcast. But by definition, the only true fiduciaries are those that are registered investment advisors, and they are fee only. They cannot receive any compensation at all from any third party through the sale or solicitation of insurance or investment products. Okay. So just want to make that very clear. The fiduciary standard does not apply to the broker dealer model. So of course you need to be a little bit skeptical. And oftentimes this free financial planning ultimately leading to these product sales, this is rampant in the broker dealer model, in these big firms. Like all of them have some kind of dumbed down financial planning tool that they'll start with. And you're going to go through some kind of process, some sort of finding process to bring in your emotions, get you super excited or super worried that if you don't move forward, then you're going to fail in your financial plan. That's not the case. Okay. But they, like I said, they are brilliant at training their advisors to approach their clients in this way. And again, oftentimes this leads individuals buying things that they may or may not need. Okay. So what are you actually paying them? Okay. So if you're not paying a fee up front or any sort of fee for what are these commissions? Now, it will be based on the company that is selling the product and also the amount of money you are contributing. But just like at a very high level, let's use a mutual fund as an example. If you're working with an advisor that's selling you mutual funds, one of the most common ones that I see is the Capital Group American funds. Again, not dogging them. I'm just telling you, the clients that I oftentimes bring over that have mutual funds, they're oftentimes American funds. Not saying they're good or bad. They're just, in my opinion, a little outdated. And typically you're going to have some sort of a sales load built into these products. Sometimes it could be an A share. Sometimes it could be a C share. Now, an A share is an upfront commission. It's going to be around 5% of what you contribute. So if you contribute $1,000, that's going to be about $50 that you pay. If you contribute $1 million, that's going to be about $50,000 that you pay. Now, there are breakpoints. So if you do contribute $1 million to an A share, you're probably receiving a breakpoint to reduce that to very low. Maybe it's going to be 1 or 2% or even lower than that. And then there's a trail on an ongoing basis. These are 12B1 fees that are also paid to the advisor as essentially ongoing commissions that are built into these products too. They're also around 1% a year. Okay. So you pay the upfront load, sales load, and then you pay fees on an ongoing basis. This is why I'm saying these are outdated, because we can have exposure into what the American funds or whatever their mutual fund is purchasing using exchange traded funds or ETFs that are a lot more, not only cost efficient, much lower internal costs, no upfront commissions, but they also tend to be a lot more tax efficient as well. I see clients all the time, legacy clients, they have these T. Rowe Price mutual funds come over. We had this client come over about a year ago now. He had this T. Rowe Price legacy fund that actually had performed decently. It was a growth-oriented fund. But in 2023, we looked at his tax return for 2023 in 2024, and we noticed he had like a capital gain of like 50,000. And we asked him, we said, hey, Mr. Client, did you sell something in your brokerage account? We're just curious because we see this $50,000 gain. He said, I didn't sell anything. I don't know what you're talking about. Well, it turns out this was a phantom capital gain. Essentially, these are capital gains that are realized by the mutual fund family because they're buying and selling securities throughout the year. They're actively managed funds. And so these taxes are then passed on to the shareholder that owns that particular investment. In this case, it was our client. So of course, at that point, the light bulb went off and he was like, this is why I want to get out of this. I want to move over to something different. Now, we didn't want to just blow up the entire fund because then he would legitimately have a significant capital gain. But what we did was we did a little trimming in 2024. We did a little bit more trimming in 2025. We want to reduce the exposure into that particular mutual fund because it is held in his taxable brokerage account. We want to make that account as tax efficient as possible. Okay. So again, I just think the mutual fund arena is a little bit outdated. But if you are working with an advisor that is selling mutual funds, you're either paying A shares, like I just mentioned, or you're paying C shares. And a C share is essentially you bypass that upfront commission, but then that upfront or that annual fee is then increased slightly by a percentage. Again, it depends on how much you're contributing, but a C share on average, you can pay upwards of 1.5 to 1.75% on an annual basis. Again, this is why I think it's so outdated. But sometimes you will run into advisors that still operate in this business model. Trust me, we see it a fair amount even in our practice. The second product that's out there that you might see are some type of annuities, variable annuities or fixed annuities. And oftentimes these will have some kind of upfront sales commission or some kind of load on an upfront basis. On average, you might see about 4 to 6%. So again, if you contribute $1 million into that particular vehicle, the commission on that will be anywhere from $40,000 to $60,000. As you can see, this is why there is a conflict of interest when advisors are being compensated by these insurance companies to sell these particular products. Of course, they're going to want to push you into those high commission products up front because they get the highest compensation up front versus someone who charges maybe a percentage of assets or maybe it's a flat fee. They're not going to receive all of that compensation up front. They must do a great service for years and then decades in order to receive that same amount of compensation. You will also pay, very similar to a mutual fund, ongoing fees as well for mortality and expenses, because when you're purchasing an annuity, you are buying the right to turn that into a life income stream. So the cost of that shows up at these M&E charges, okay, mortality and expense charges. And most of the time, they could be upwards of 1% annually. And these are not very clear. You typically will not see these debited from the account. Sometimes you might, but oftentimes there's not a lot of clarity in these typical these annuity products. But you should expect to pay somewhere in that arena upfront and on an annual basis. Life insurance is another product that is oftentimes sold in the broker-dealer world, no question about it. And that's a whole nother argument whether or not you need or want permanent life insurance to begin with. Now, I oftentimes see these types of products pitched as some kind of savings vehicle. Okay. Now, this was the company that I worked for right out of college. They were really heavy on selling permanent life insurance. Okay. For better or worse, not saying permanent life insurance is all bad. I still own my permanent life insurance policies that I purchased when I was 21 and 23 years old. Okay. And they have done quite well for me. Okay. So actually, I do think permanent life insurance could fit in the context of an overall plan. But there's a different argument in terms of, okay, you're approaching retirement, you're 60. Do you need or want permanent life insurance? Regardless, if you need or want permanent life insurance, you could expect to pay somewhere in the neighborhood of 50%, even upwards of 100% of that first year premium in some sort of commission. Now, you're not paying the commission out of pocket. You're just writing the check to the insurance company because that's what the premium is. And the insurance company is compensating that particular agent or broker. So if you contribute $100,000 to a permanent life policy and it's a 50% commission, you can do the math. That's about $50,000 of first year commissions for that particular agent. Again, thinking about the conflicts of interest and what that might look like if your advisor is incentivized to sell these insurance and annuity products. I'm going to continue to bang the drum here that not saying these products are all bad. Many of these products are great solutions to the context of an overall financial plan. But who's recommending that product and how they're compensated, in my opinion, matters greatly. So all of these arrangements are in the broker-dealer model. And like I mentioned, they're not held to the fiduciary standard. But I also mentioned they may also be held to a fiduciary standard sometimes. Maybe they are also not only a broker-dealer agent, but they're also a registered investment advisor or investment advisor representative. And so therefore, they can charge fees for managing investment products. So there are many times these arrangements with these broker-dealers where they can do both. They can do the commission-based model and they can charge a percentage of the assets under management. So why don't we talk about the hybrid model? This is the next one. So we already mentioned the commissions that can be received and the potential conflicts there. And all of the big firms, they have these types of arrangements. Your Merrill Lynch, your Morgan Stanley, your Edward Jones, your Wells Fargo's. Okay, they operate under a broker-dealer, but then they also operate as a registered investment advisor, and their advisors can be fiduciaries on those investment accounts, and they can give fiduciary investment advice to you as the end client. Now, to my knowledge, every single one of these firms, they operate as a percentage of the assets that they're managing. Okay, so the AUM model is what you may have heard. And about 10 years ago, when I was really deeply researching leaving the big box firm environment and going independent, in my research, I found that the average AUM fee or assets under management fee was about 1.65%. However, the challenge with that statistic, it was based on all accounts across all account sizes. Okay, the fees for all different account sizes. So what I mean by that is generally as the account size go up, the fee as a percentage goes down. All right. So again, if I were to look at the clients we serve, which are folks that have saved between $1 million and $5 million, for retirement. The average fee is usually around 1% for $1 million. And then it's a slope downwards until you hit that, maybe it's 0.7, 0.75% on an annual basis. So someone with $1 million portfolio who's being charged 1% will pay on an annual basis $10,000 per year. Someone with a $5 million portfolio who's being charged 0.75% will pay about $37,500 per year. So, and again, this is in addition to any commissions or loads that are being generated through product sales. And we'll talk more about that shortly, because the issue I have with this, oftentimes, because the fee is tied to the percentage of the assets under management, quote unquote, and because it is typically, for better or for worse, a volume play with many of these big shops, there's little to no service being provided outside of the very basic financial planning analysis, okay? And very rarely is any real tax advice being included in this. Now, I'm not talking about tax preparation, like doing their tax return, but I'm talking about efforts to minimize your lifetime tax bill. Things that we talk about all the time on this podcast: Roth conversion strategy, Social Security timing, IRMA, legacy planning, charitable giving, strategic withdrawals, tax loss harvesting, ACA premium tax credits, okay? I don't have a problem with the fee, okay, as long as it's the 2025 service model is being provided, okay? So the fees are transparent, meaning like, hey, this is what we charge and this is what it is from a dollar perspective, but also the service you're receiving is represented in that fee, okay? So if you're being charged a percentage that's close to 1%, but you're only getting investment management advice, I might reevaluate that if I were you, okay? And we'll talk more about that here in a moment. The other model that's newer, I would say, XY Planning Network really is the one that I think spearheaded this movement, is this movement for advice only. Now, I think just about every firm that is advice only, like pure advice only, they're all independent financial planning firms and they're all registered investment advisors. So it's kind of like a subset of advisors within the independent RIA space, which is what I operate in. But I am hearing some bigger firms who are trying to adopt some kind of fixed fee model for one-time financial planning engagements, or even some sort of subscription model without an AUM percentage fee, which I think is interesting. But generally, the advice only movement is just that. It's advice only. Okay. So it's a one-time project. It's a one-time comprehensive plan, monthly or quarterly, and it's a subscription model. And it's generally being offered by independent financial planners, which is great. Now, who is this for typically? Typically DIY investors who want a second set of eyes. They enjoy managing their own portfolio, but they want maybe validation on what they're doing, validation on their strategy. They don't need hand-holding, but they want a fiduciary to stress test their decisions and like say, hey, like I want to do most of it myself. I enjoy it, but I don't want to screw it up. That's probably a lot of you listening. It could also be professionals or entrepreneurs, with complex situations, maybe high stock compensation strategies or maximizing deductions, or maybe it's a business owner and they need help with their retirement plans or their tax planning strategies. Okay. They may not have a substantial investment portfolio to manage, but they have significant planning needs and they don't want to be sold product. They just want tax smart financial planning only. It could also be for young families that are building wealth. They don't have the assets under management, but they want financial planning help. Okay. It could also be for transitioning retirees who, again, want that one-time check-in. Maybe they are comfortable with managing a lot of the things, but maybe they want a second set of eyes on one or two things. The advice-only model is great, okay? Now, just for many of you listening, you might be wondering, well, Kevin, do you do advice only? Well, it's an offering we do charge for. We don't really advertise it heavily, but we've done maybe 10 or so of these engagements since launching our firm in 2021. So it's definitely not the primary clients or profile of the folks that we serve. In 2025, we've done 0. Okay. All of our efforts are being poured into serving our ongoing financial planning and investment management clients and tax planning clients, because that's just where we get the most excitement and enjoyment for the work that we're doing. But it's definitely a nice option for the right client profile. And I mentioned this fits kind of within the subset of the fee only, the RIA model. Okay. So let's talk about the fee only model, because this is oftentimes confuses people as well. So what might you pay for something like this? It totally depends, okay? I think for you listening, if you're listening to this podcast, you're probably in that approaching retirement phase or recently retired phase. I'll just tell you what we charge for a one-time engagement is $5,000 one-time fee. You pay half upfront and half at the time of the plan delivery. And I think that's pretty much right in line with what a lot of other financial planning firms might charge. We might be slightly on the higher end, for better or worse. We can do that just because we have the expertise, and in my opinion, we deliver the value in multiples of that particular fee. Probably on the lower end for a one-time engagement, a comprehensive engagement, you might look at $2,000. But again, I think that would be on the low end. In my opinion, that advisor is not really doing themselves justice charging that little for a one-time planning engagement. They don't understand the heavy lifting that goes into getting a financial planning engagement right and doing the deep dive into the client situation, not only quantitatively, but also qualitatively. Okay, I think they're kind of undercharging based on the value they're providing, but you could probably see anywhere from $2,000 to $5,000 for a one-time engagement. For project plans, I'd say an hourly fee of around $200 to $350, maybe $400 for an hour is probably a reasonable amount you should expect to pay. And again, I'm going to link some information in the show notes about where you can find these types of advisors. Subscriptions are also pretty popular, where you might pay a monthly or quarterly subscription fee. Again, for the profile for who I'm talking to, you're probably looking at a minimum of $5,000 per year, upwards of about $10,000 per year or more for those types of subscription-based models that do not include any investment management. It's just ongoing financial planning. So it's kind of nice that you can select, and I think the market is still trying to price what is appropriate here. So I think firms are kind of all over the place, truthfully, in terms of what they're charging and what their service level is. But again, I think on the low end, $2,000 for a one-time plan, upwards of probably $7,000 or $8,000 for a one-time plan. And I've heard of firms charge $10,000 for a one-time plan, truthfully. Ongoing, you might be on the low end, $5,000 per year, upwards of $10,000 plus per year. And then for project or hourly engagements, you're probably looking in that hourly rate of, I would say on the low end, 150. I mean, low end 150, upwards of maybe $500 on an hourly basis to just answer a couple of things. Like, hey, when should I start taking Social Security? Or when should I start Roth conversions? Something along those lines. Okay. So again, I mentioned earlier that the advice-only model is sort of a subset of the RIA model or the fee-only model. Okay. So the fee-only model, let me explain what that means. Fee-only, like I said, includes advice-only. But essentially, a fee-only means the advice is provided and never will compensation be received from a third party, from a broker-dealer or any financial firm or anybody for that matter. No commission-based compensation can be received. It must be received from either investment management or financial planning, and the fees are paid directly by the client. Okay. So independent fiduciary firms like the one I run at Imagine Financial Security, that's the most popular fee-only model. But there are bigger firms, okay, like bigger box firms that you also see that are also independent and that are fee-only as well. Okay. Now, like I mentioned earlier, where it gets a little confusing is that a lot of these big firms, like a Morgan Stanley, they have a broker-dealer arm, but they also have an RIA arm. So it's under one umbrella, Morgan Stanley, but then they have this subset of commission-based sales and then investment advisory services and solutions. So it can get a little confusing, and many of those advisors and many people use the term fee-based, which means they can receive fees, but they can also receive commission. So just keep that in mind. If an advisor says fee-based, that does not mean they are fee-only. Fee-only means fee-only. Never compensation from a third party, operating under the fiduciary standard at all times, period. Okay, no, sometimes I'm a fiduciary, sometimes I'm not. Always under the fiduciary model in the fee-only space. We already talked about advice-only, but what about for advisors that are not only doing the financial planning and financial planning advice, but also managing investment assets? Well, typically they're being compensated based on an AUM, a percentage of AUM, or being compensated based on a flat fee, which will also include investment management, like I mentioned. This is how we charge. Okay, we started out charging a percentage of AUM. We've transitioned into a flat fee model for the last 2 years, and I like it for the transparency aspect, and also conflicts of interest, truthfully, are there in every industry, financial services, every industry, okay? And I recognize that we're not immune to conflicts of interest. But what I wanted to do was try the best we could to eliminate all conflicts of interest possible, okay? And I like the flat fee model for many reasons. And I'll give you an example of that right now. So literally a new client we're bringing on. She is a teacher for the state of New York. And she has a very unique retirement account, this TDA account, tax deferred annuity account. It's another term for a 403B plan. But she has this fixed interest option in this TDA plan. And it's only available in the TDA. Like she couldn't roll this money out to an IRA and invest in that particular fund. Okay. It must be done inside of that TDA plan, which is administered through the state union for teachers. Okay. And the interest rate right now on that particular fund is 7% on an annual basis, guaranteed. Okay. It doesn't go up and down with the market. The principal doesn't fluctuate based on bond prices. It is a fixed 7% a year. And I'm not saying every AUM percentage advisor would do this, but it's very possible. Okay. If we were charging a percentage of assets to manage, it's very possible we might have the inclination to recommend that particular client to roll over those funds, or at least part of those funds, into an IRA that we're managing for her. That's not the case because our fee does not change. We have a flat fee, we have a minimum fee, and then we have different tiers. But our fee is flat, regardless if she does that rollover or not. We're still going to advise her as part of the context of her overall financial plan. But our recommendation was to her was, hey, Mrs. Client, let's keep that in the TDA plan. You're earning a 7% guaranteed. What that allows you to do now is to actually really eliminate all of the other safe money we would potentially need in your other investment accounts, your Roth accounts, your taxable brokerage accounts, your husband's IRA, your husband's 401k, maybe not eliminate, maybe that's a little aggressive, but reduce substantially the amount of fixed income or bonds we would need in those other accounts because you have this silver bullet, this 7% guaranteed fixed account that's only available in your 403B plan. Like I said, I'm not saying every advisor that charges a percentage of AUM would recommend the rollover, but I'm saying it would be more probable for that conversation to happen. And again, this is sort of also where I'm going in terms of the transparency. If I'm the client and I know that's how the advisor is being compensated, even if that recommendation did make sense, let's kind of play a game here. Let's pretend that maybe the client had too much money in that TDA plan, and therefore they were being too conservative with their investments, and they needed to do a rollover to take on some risk to keep pace and exceed inflation. Now I recognize 7%, you're going to exceed inflation over the long run, but let's pretend here. Let's pretend that the recommendation was in her best interest to do a rollover for a part of that TDA plan. If the client knew that the advisor is being paid based on a percentage of the assets under management, are they more likely or less likely to proceed with that rollover? I think they're less likely to do so. Okay. Maybe again, that's just how my brain works. I'm a skeptic when it comes to these types of things. I'm like, what's the angle here? And that's why I believe we've structured our firm the way we've done it, is so we can accommodate for the skeptics out there to be like, listen, we hear you. We understand that that's a concern. So therefore, we're not even going to make that as a conflict. We're going to eliminate that conflict as part of the conversation, period. So that's why we went flat fee, among other things, transparency and a dollar amount as opposed to percentage. But again, I think the key is for fee only, no commissions ever. Okay. Now you could see some conflicts on both sides. Like I just mentioned, there's the conflict on the percentage of AUM side. There could also be a conflict on the flat fee side. Let's pretend an advisor was listening to this that charges a percentage of AUM and said, you know what, Kevin, you're not incentivized to grow the portfolio for clients over time because you're not charging a percentage of AUM. Meaning I'd rather you charge a percentage of AUM and grow my portfolio so we're aligned. That's exactly why at the very end of this podcast, I'm going to tell you that there is no right or wrong fee model. There is a right fee model for the right client. And if you're saying that, you may be in a different life stage. Maybe you're in the younger age or the younger phase of the folks listening to this podcast. You still have room for accumulation. You want to be aggressive with your accumulation. Okay. Maybe that's how you want your fee to be to your advisor. And I'm not saying that's right or wrong. I will say that just because an advisor's fee is flat does not mean they don't have incentives to keep pace or exceed certain benchmarks that they may put out for the client. That's not the case at all. Okay. However, what I'm saying is I like the flat fee model because when our clients are transitioning into retirement, we don't have to worry about conflicts with rollovers, what doesn't roll over, what does roll over. But then furthermore, one of our core pillars from an income or spending perspective is we want our clients to maximize their lifetime spending. We don't want them to just preserve and hold on to all their portfolio so they die with this big pile of money that they've never enjoyed during their lifetime, right? And I'm not saying every percentage of AUM advisor is like this. However, think about the 4% rule as an example. How many times have you heard financial advisors preaching the 4% rule when in reality, it's more likely to leave you underspending in retirement than running out of money? So therefore, how much more money is that advisor keeping under their management by recommending the 4% rule versus something that is a little bit more fluid? Maybe it's guardrails like we've talked about in the past. Maybe it's a higher spending plan. Maybe it's 7 or 8% a year in terms of your annual spending distribution during those go-go years. Not saying that percentage of AUM advisor is not going to recommend higher spending rates. However, it just eliminates that conflict. And I've heard that from clients specifically. Like, Kevin, I feel like they're not recommending I spend my money because they want to keep more of it in their portfolio under their management. Okay. I'm just saying, I've heard that from clients, and this is partly why we moved into the direction that we moved into. You could also argue for the fee only advisors. You could also argue and say, you know what? They don't sell insurance or annuity products. So therefore, they may not be an advocate for or recommend those products, even if they are a good fit for the client. You know what? I completely hear this 100%. I do believe that many fee-only advisors are very anti-insurance, anti-annuity. Okay, that's why I did one of the podcasts. I can't remember the episode number, but go back and listen to that one. The annuity bias that's harmful to retirees. I talked about that with two other annuity folks in the industry, and that was my big concern, was that many fee-only advisors are very anti-insurance, anti-annuity, because of the healthy skepticism that we both have, we both share, and therefore that bleeds into the recommendations from clients, even though sometimes that solution is the right thing for them. This is another reason why I like the flat fee model, because let's say, for an example, a client has a $2 million portfolio. And let's say we're running the financial plan and we're like, you know what? Given their longevity, given their conservative risk tolerance, given the very low percentage of their cash flow needs that are being represented by guaranteed income sources, maybe annuities make sense for a part of their portfolio. Maybe they take $250,000 or maybe it's $500,000 out of their $2 million portfolio and turn that into a life annuity for those reasons. Well, an AUM percentage advisor that does not sell commission-based products might be a little hesitant to do that because that's going to impact their compensation long-term. Whereas the flat fee model, we don't have to worry about that. We charge a flat fee regardless if they annuitize the portfolio or they choose to keep it liquid and choose to keep it invested in more traditional types of securities. So I've worked in all of the fee models throughout my career. And I can truly confidently say there's no right or wrong fee model. There is a right model for the right client or potentially right models for the right client. However, choose your advisor based on the services you need and the fee model that makes sense for you, among other qualitative factors. I think for me, the biggest aha over this whole process, transitioning from broker-dealer to the bank wealth management side to then launching my own firm in 2021 was this idea of tax planning. Okay. I think that was my biggest aha moment. Advising on taxes at the big firms, it was a compliance nightmare. If I mention tax in an email, I'm getting a one-on-one with the compliance officer the next day. And the issue that I saw was most of the families that we serve, and still to this day, they come to us with all or at least most of their assets in traditional 401ks and IRAs. And a big concern for them was how to navigate taxes in retirement. So as an independent advisor, we cut out the corporate bureaucracy and now we can talk about taxes. So I think, for me, being an RIA, a registered investment advisor that's independent, that's been the biggest blessing throughout this whole process. Not like the way we charge fees or, do you charge a percentage of AUM or flat fee? I think in the end, it's going to be around the same dollar amount. I think over time, you're probably going to pay a little bit less to a flat fee advisor than a percentage of AUM advisor, simply for the fact that markets do go up over time. And that is a factor too, is that, your fee is going to go up with the markets in lockstep. So if your portfolio is averaging 7% a year, your fee is likely to go up 7% a year as well. But for me, though, I had another aha moment during that process of launching my own firm and talking actively about taxes with clients, is that I understood the concepts that are relevant to my clients, that we've talked about on the podcast many, many times, but I've never done tax preparation in my career. Okay. And it resulted in a very steep learning curve and it was very uncomfortable for me. And this is why Roberto and I connecting last year was a godsend. It's amazing how he works. I don't know what your beliefs are, but amazing how God works in my life to bring people together and brought Roberto to me and brought us together. Because now when we're doing tax planning for clients, we have both lenses. We have the financial planning lens, which is where my background is. And we also have Roberto's lens, which is the tax preparation side, which he has done for the last 6 years. And it's essentially just making sure that the tax planning strategies that we're doing for our clients are actually showing up on the tax return accurately and identifying opportunities throughout the year. Was the tax return done correctly? Let's run some projections in terms of what your income might be for this year so we can actually make sound decisions on Roth conversions or tax loss harvesting or capital gain or tax gain harvesting, right? But as a result of this, many of our clients have now asked us, hey, Kevin, Roberto, Amy, are you guys going to help file taxes in the future? And our answer had been at the time, no, but maybe someday. And I'm excited to announce that someday may be this upcoming tax season. And Roberto and I, we've had some conversations about this, and we see the demand from our clients because of what I just mentioned. And I think the future of our firm, I'm going to just go ahead and make a prediction here. No pressure here, Roberto. But for the clients that we serve, it's going to be core financial planning, retirement planning and investment management, tax planning, and now tax preparation. And I do believe this is the future for firms like mine, a one-stop shop where it's legitimately 100% coordination between the financial planning team and the tax planning firm or the tax preparation firm. Because even though your advisor may be friends with the CPA or they may know the CPA loosely, or maybe they don't even know the CPA at all, it's very difficult for the CPA firms who are not doing financial planning to really communicate and talk to the financial planner or the investment advisor. Okay. So I'm very excited because now we can bring that in-house. We can not only do the tax planning for our clients, help them reduce their lifetime tax bill, but now we're going to potentially offer, and I say potentially because we're still in talks about this. I'm not guaranteeing this at this point in time, but based on the response rate that we've had from our existing clients, it is highly likely that we will be offering tax preparation services in 2026 for the 2025 tax year. Now, I will say, with the qualifier, number one is that we're not going to just take on clients that are just doing tax prep. Okay. So we're not going to take someone off the street that's like, hey, I want you to file our taxes. You must be an imagined financial security, financial planning client, period. No exceptions, no family members or friends that kind of sneak in the back door. Hard rule on that one. And number two, we are going to refer out the complex returns. Okay. So if there's a business or there's some complicated K-1 distributions, maybe some rental properties that require some complications in terms of depreciation, et cetera, we're going to refer those out to a CPA firm. That's what they specialize in. But for our bread and butter clients that are retired, they're taking some distributions from their IRAs, maybe doing some Roth conversions, maybe they have some capital gains, maybe they have some interest income, maybe pensions, maybe Social Security. We're going to be taking those returns in-house, doing that service for them and making sure that the tax planning that we do, most importantly, shows up on the tax return from every single client. So what is a reasonable fee? Unfortunately, it is hard to answer this question on a podcast, all right? Because smaller accounts may have lower complexity and therefore, they may have a lower fee, but their fee may be higher as a percentage of their account. Larger accounts, they may have more complexity. They may be paying a higher dollar amount, but as a percentage, it may be lower as well. Or maybe there's nothing liquid to manage or business owners. Okay. So like I said in the beginning, I'm going to try to speak to the crowd that we serve. Someone who's around the age of 60, who's recently retired or planning to retire. They've saved $1 million to $5 million. They want to fire their boss, play more golf, travel the world, cherish their loved ones, enjoy retirement and worry less about money. But I have 5 recommendations for you. Okay. I think the first one that I want to put out there is find an advisor who is retirement focused. Okay. You don't need a generalist at this point in time. If you're listening to this podcast still, you're PFR Nation. You do not need a generalist. You need a specialist who specializes in retirement planning. There are so many little nuances that a generalist who's servicing 400 or 500 clients, and maybe they work with some retirees, but maybe the majority of them are W-2 that are 35 or 50 years old. Maybe they're high income, but there's different complexities there. Okay. So find an advisor who is retirement focused. Number 2 is find an advisor who is not only going to manage your investments, but also help with the other key pillars of retirement planning. So the 5 pillars, at least the 5 core pillars that we solve for with our clients: income and cash flow, number 1, investment strategies, number 2, tax optimization, number 3, insurance and risk management, number 4, and legacy, number 5. Make sure that advisor, if you are paying them a percentage of your investments or a flat fee in a dollar perspective, make sure they're not only managing investments, but also advising on the other core areas of financial planning and retirement planning. Number 3 recommendation, calculate the fee from a dollar perspective, not a percentage. I don't care if it's flat fee, advice only, broker dealer, AUM percentage. Calculate the actual dollar fee. And as long as those fees are supported by the services you're expecting or receiving in 2025, then we're good. Okay. So a percentage of $2 million, if you're paying 1%, that's $20,000 per year. What are you receiving for that $20,000? Not saying that fee is right or wrong, but make sure that you know what the fee is from a dollar perspective and compare that to the services you are expecting to receive in that given year. Number 4, I'm probably biased on this one too, but don't worry about location. It's 2025. We're in the post-COVID world. Some of the best advisors I know operate 100% virtually. We're kind of a hybrid mix. We have some clients that meet us in Jacksonville, Florida, meet us in Chattanooga, Tennessee, which is where we have 2 offices. But most of our clients are virtual. And even the clients that live in those cities that we work in, they meet virtually most of the time anyways, because they don't want to sit in traffic. For efficiency purposes, maybe they want to meet in person once, but they're good after that. So I think if you understand that, you can find a retirement-focused advisor who charges reasonable fees, and that's an expert in retirement and taxes, but also is virtual. It opens the door for more potential advisors that are the right fit, because you may be sitting in some podunk city somewhere in Florida. You know what I mean? Maybe the closest city is 2 hours away. Closest big city is 2 hours away. So you don't have a lot of retirement-focused fiduciaries around your neck of the woods. You need to find an advisor that's virtual. So get comfortable with that. And don't worry, it's okay. We're in 2025. Let's get with the times. Number 5, if you're married, typically there is the CFO spouse and the non-CFO spouse. And it's very likely if you're listening to this podcast, you are the CFO spouse. So remember to not only think about what you want or need, but also what your spouse may want or need if something were to happen to you. I have a dear client who I've been working with now since 2018. And when she first hired me, her husband was alive. He had Lou Gehrig's disease and he was declining pretty quickly. He wanted to hire a fiduciary advisor before he passed away. He wanted to make sure his wife was taken care of. And so he began the interview process. We hit it off. He liked my value proposition. She liked my value proposition. He hired me. And lo and behold, about 2 years later, he passed away. And she is forever grateful that he took that step to actually do the heavy lifting and hire someone that he had the stamp of approval on, because if he left it up to her after he passed away, it would have been so overwhelming to her. I promise you that. And it's very likely she could have been taken advantage of by some snake oil salesman at some broker dealer or some big financial firm. Now, on the flip side, there have been stories like that too, where you heard of widows that are not the CFO spouse. Their spouse handled everything and now they're stepping in. I oftentimes feel resentment from that surviving spouse. Like, why didn't XYZ set me up properly? Or why didn't they set me up with a good financial planner before something happened? Now, no one has a crystal ball. Sometimes these are unexpected, right? But I say this because we're not Superman, we're not Superwoman. And if something were to happen to you as the CFO spouse, just picture in your mind how your spouse, your surviving spouse, how they would react. And what would their first step be? Do they have a first step? Okay. And so even if you're not ready to hand over the keys fully to some person that you don't maybe know or trust yet, maybe it makes sense to set up some kind of relationship. Maybe it's even doing a one-time engagement first, just so you can get comfortable and familiar with that person's advice, or maybe pay them an hourly fee or whatever it might be. Or maybe they're managing some of your investments for a year. You kind of say, like, hey, are they doing what they say they were going to do? Or maybe it's they're actually implementing part of your financial decision making. Because I promise you, if something happened and you did not set your spouse up properly, there is this sense of, I hate to use the word resentment because it is a strong word, but there is this sense of like, what were you doing? Why not? You know what I mean? And typically it's because it's a hard-headedness. It is the healthy dosage of skepticism, potentially fees. There could be a lot of different reasons. Lack of trust, not finding the right advisor yet. I think there could be many, many reasons why the CFO spouse is still holding on. They don't want to let go of control. But I'm just telling you from my experience, this is probably the number one reason why DIY investors hire us. Not because they can't do this themselves, but because they want to make sure that their spouse and they have a partner with as they go through the aging process. So enough on that. So in summary, listen, cost is only an issue in the absence of value. Okay. So a reasonable fee is directly related to the value you are receiving, which should be a multiple of the fee you're paying. If you're paying around 1% of your portfolio, again, in the metrics that we mentioned, 1 million to 5 million, and you're just getting investment management, maybe financial planning or tax planning as a complete afterthought, you are most certainly overpaying. And I know this because I know of at least a dozen firms like mine who are doing all of those services for around 1% or less. But if you're paying a percentage or a flat fee for retirement planning, and you're getting tax planning, and you're getting investment management, and you're getting cash flow planning, and you're getting estate planning, okay, and insurance planning, it should probably be around 1% or maybe slightly less if your portfolio is a little higher, okay? So could you find firms that charge less than that? Absolutely, yes. I mean, Vanguard, I think they charge 0.35% for their advisory services. Now, do they do tax planning? No. Are they stretched a little bit thin based on the number of families that they serve? Absolutely. Okay. Is there a turnover issue? Absolutely. From my experience, because I worked at a big firm like Vanguard, these firms experience extremely high attrition. And it's like this churn and burn model, both on the client and the advisor side. It's just like the BD world. It's a volume play. And from my experience, the more volume an advisor is responsible for, the more difficult it is for that advisor to truly deliver the value that you all deserve. Okay. And then you run into the issue of the revolving door of advisors, which is never pleasant in the end. And believe me, I used to experience this as an advisor. I would inherit the legacy clients who were ticked off because their advisor kept quitting or getting promoted, or maybe their advisor just didn't have the capacity for them any longer. It's not fun. So I guess in summary, I'm celebrating our 4 years of independence and having flexibility to work with great people whom we want to work with and whom we enjoy working with, and being able to deliver value and service far in excess of what we could have at a big firm, at a bigger shop. And yeah, we're just super grateful. We're super excited about the future. It feels like, hey, 4 years is great, but we're just getting started here. And ultimately, the opportunity that we see in the long term to sort of merge the whole tax piece with the financial planning piece, we feel like that's going to add so much value to the clients that we serve. But I know this is a lot of information. And like I mentioned earlier, if it helps, I did write that article, the blog post article, How to Find a Retirement-Focused Advisor. I'll link it in my show notes. And I know it can be overwhelming. But if you're enjoying our content, if you're finding value in what we're talking about, remember, this is what we do on a day in and day out basis. And if you're interested in learning more, you can either visit our website, www.imaginefinancialsecurity.com, or you can just get started with the retirement readiness questionnaire linked in the show notes. We just ask for some information, a lot of details about your situation. And that way we can come up with an initial observation list, if we were to work together, what that might look like and what we might charge you. We would love to help you in that retirement planning journey. And if you enjoyed this episode, make sure to follow the podcast, of course, and also make sure to subscribe to our YouTube channel. We've got some great videos that are complimentary, that complement the podcast, and they're released every Thursday. They are designed specifically for you all, PFR Nation. And if you are feeling nice, leave that 5-star review wherever you consume the podcast, Apple Podcasts, Spotify, or even better, both, right? Because it does help tell the algorithm that you're digging our show, and others like you will do the same. So happy Independence Day, everybody. Hope you all have a great week. See you next time.